Good afternoon and good morning, everybody. My name is David Apple. I'm the head of the SaaS vertical here at Sage Intech. We're so excited you joined us. This promises to be a pretty entertaining session that we're going to have with the speakers that we do. This is our way of wanting to pay it forward, that so many folks are trying to think about, what do I do? How do I manage? And what are my peers doing? So we brought this great group of folks to come together to talk about it. I want to do a little bit of a setup right now on this. You may have seen something like this. There's this macro environment that we're all in, but it's pretty universal that folks are thinking that things are getting better. And so how do I prepare for the rebound? So this is somewhat, for this time and this place that we're in right now, focused on trying to help you and people that you are looking out for get through all that. There's three things that Matt, Bruce, and I are going to go through on doing this. And this, we didn't just make this up. I spend a lot of time with our customers, done 121 customer interviews, and we just ran a survey, over 400 participants. And this is what everybody said they're concerned about. So this is why we're trying to talk about these particular topics. How do you get CAC and churn down? How do you think about the culture that you've got with people, process, and technology to make better decisions? And then, because we really help the finance function, the roles changing, and what is that going to wind up looking like? So with that, I want to introduce my co-speakers. First, Bruce Croxon's managing partner, Round13 Capital, very strong background in go-to-market models, and has some really wise, astute things he wants to share. Bruce, you want to build on top of that?
Oh, thanks, David. Yeah, no, I'm a lifelong entrepreneur and have spent a great many years actually working in the area of customer acquisition as I was building an online dating company. And to the time I left as CEO, even with 600 employees, I looked at my customer acquisition every day and had a good idea where the customers came from and what they were worth to me over time. So I am for sure a convert on how important an area this is to building businesses, and never more important than today, because we can't rely on the technology to keep out competitors. It really is about sales and marketing. So happy to be here. Thanks for the introduction, and look forward to spending the next hour with you.
Next person I want to introduce is Matt Hodgson. Matt is the Chief Financial Officer of Vidyard. If you haven't heard of Vidyard, they're just tearing it up, and all the more appropriate right now because of what they do with the video platform. Their business is on fire. And up in the Kitchener-Waterloo area, this is just many ways Matt tries to help others, because he's a big part of the tech finance community up there, where everybody helps each other out through big decisions and questions. A lot of trust, a lot of camaraderie up there. Matt, you share a little bit about yourself?
Yeah, sure. Thanks for having me. Appreciate the opportunity. And so yeah, quick summary about me. I guess I've been in the space for about 16 years. I spent the first 8 years at Ernst & Young, actually, and the latter half of that focused on tech and growth stage companies. And the last 8 years I've been here, Vidyard, CFO, and I joined when there's about 10 of us, and now there's over 200, and still growing quickly. So, yeah.
I want to jump into CAC to begin, and this isn't going to be a big presentation. Like, this isn't a slide-based discussion, but the slides are meant to give a little bit of a visual to what we're going to wind up talking about. So let's just start with CAC, and probably you know this, but let's sharpen the saw. What CAC is the total sales there in the upper left-hand corner. Total sales, marketing, customer success costs to acquire a customer. Different people package that differently, so you always got to make sure you know what you're going to compare against. And this is from one of our Intex investors before we were acquired, Bessemer Ventures, sharing what some of the good, better, best is coming about. But let's dive into it. Bruce, with all your background on CAC, let's start helping everybody out. What should people be thinking about?
Well, I think you touched on the first point, which is what you include in the definition. You know, we get a lot of presentations coming in, and it can be a little bit misleading, and you can fool yourself, quite frankly, if you don't put in fully loaded costs and what it costs to get a customer. And I'll give you an example. On many business-to-business software companies, you've got your frontline salespeople for sure, but then it often takes, you know, a fair amount of hand-holding to get a customer in and climatized and actually using the software. So not to include the hand-holding costs, to somehow maybe lump those into customer service as a separate bucket, I think you'd be doing yourself a disservice, because you'd end up thinking you're acquiring customers for a lot less than you are. So that's a very sort of specific point on the first bullet. What is CAC? I mean, in general, and I'll state the obvious, and I think the one thing about this chart is it is a little bit dependent on what kind of business you're in, because, if you can be in a business where the annual revenue is quite large, you're obviously willing to spend a fair amount more. And if you're developing a feeling that your customer once landed may in fact be with you for the rest of our known business life, you would be willing to spend more if you could make sure that they're not going to churn out, say, in 18 months or 24 months. So there is a little bit of variability to that. So, the right-hand part, it's not cast in stone, but I think it's a pretty good guideline to start.
Well, and to build on that, and for those of you, the founders, because I had a chance to see a lot of your backgrounds, a lot of you are building companies, is trying to be intellectually honest with yourself, because you can game the numbers and make yourself feel good, but money is money. And so you really want to understand what it's taking and have people take an honest, sober assessment of what they're really doing to really understand how to move the levers. And I just don't treat it as a vanity metric. And Matt, you as CFO, right, you've been through that growth of Vidyard, going through that. Like, help your peers out a little bit. What should they be thinking about in trying to manage this and having that intellectually honest conversations?
Yeah, I completely agree with that. It was 100% my first point, was make sure you're doing a fully loaded CAC. I mean, fully loaded acquisition cost is key. Don't discount anything out, don't move anything around. The other things that I've learned along the way, the things that we're doing now, separating it out. If you have different segments, different units, we have enterprise customers and mid-sized customers and startups. So separating out your acquisition costs by division or by segment will really help as well. And again, it's all about being honest with you. How much are these customers costing you to get, and how much are they worth to the business? And then you can work on your numbers, you can work on increasing efficiency, but you really need to understand that before you start chipping away at it.
And so here's some metrics to think a little bit about. We want to transition this over just to thinking about next on churn, because what's it take to get you in? But Bruce laid out, really understanding who your buyer is and what problem you solve for them. That's how they get seeing the value for that to manage the life cycle. That's kind of the metrics you want to do, and that's going to be various for what your answers are to that question. So churn can get packaged and just defined a lot of different ways. Bruce, you as the investor see a lot of different models. You want to walk people through some of the things you see?
Sure, and let's start with just how important this metric is, because I've been in the tech industry for 30 years, and I grew up in a time when the technology in and of itself provided a barrier to entry. Like, if you had some sexy tech that was complicated and expensive, you could actually keep other people out of the business. And it acted as a barrier to entry. That is, so far from the truth today. It's very rare that you find the technology itself acting to keep somebody out. So what does that mean? It really has become a sales and marketing barrier to entry. And a big part of sales is retention. I mean, if you're doing a great job on the marketing front and generating leads at a reasonable rate, which is a component of the CAC calculation, and you are converting and getting interest, but then not doing enough to keep the customer, then you really are filling a leaky bucket, right? And it'll be very difficult to grow, because you're going to have to grow in excess of the number of people that are coming out the bottom. So, so much of the time we're spending our focus on the front end and making sure we market correctly and get the webinars and get the go-to meetings and make a great presentation. But the technology and measurement and the data also exists for us to see who's using the product, right? And if you're not using it, why aren't you using it? And that follow up and that engagement, which is so critical. And I'll just flip that all around. If you are successful in getting those two things to work in sync, and you are successful in a business to business software, for example, of getting high customer usage, the costs that come out of this, to the extent that if you do your job and you don't let the customer down from a software perspective, and they are actually ingraining it into their operating system, there's no real reason to lose that customer. If you think about it, you know, I mean, in the old days, it was a big number to replace the tech, but you had to renew every year, so you had to resell it every year. But this, you know, relatively acceptable, modest, you know, non-capital intensive monthly fee, sometimes an annual fee. You do your job, there's no reason to churn, but you have to pay attention to that and make sure that you keep people engaged and do that part of your job too.
Matt, would you share, you know, we're back to churn, and you guys, I think it might be useful to just tell everybody for context what your guys' billing model and pricing is, the public stuff, and then get into a little bit how you've gone through the decisions, because it's equally important as how you went through the decisions and how you guys are managing this is, I think, the real powerful takeaways for the audience.
Sure, yeah. You know, Bruce is right on the money with this stuff, and probably from our perspective, Vidyard, most of our contracts are annual contracts. We do have some kind of monthly sign-up, monthly recurring revenue stuff, but the majority of our business is based on an annual contract cycle, more of an ARR type model. So a couple of things I would add is, you know, to close off on the customer acquisition side and thinking about the cost to acquire a customer, should also think, you know, you need to think about retention, but then also think about, as Bruce said, are your customers using and ingraining your product? And with that, are there opportunities, or are those customers upselling in the first year that they come on board? Because that is a big factor as well. And you can probably afford a bit higher of an acquisition cost if you know and have some reliability that those customers are indeed going to increase their contracts within that first year. So that's something to keep an eye on. The second point I'd like to make is that, you know, we're talking about churn, and that's really related to that monthly recurring revenue model, and you're watching that monthly churn on an annual basis. You talk more of retention, same idea, but you really can't measure accurately your retention until you go through a renewal cycle. So if you've got a whole pile of customers that have signed on and you have a fantastic retention rate or renewal rate, if you haven't gone through an annual renew cycle, you haven't really figured that number out yet. So make sure you're conscious of that. The cohorts as they renew is what you've really got to watch to measure that retention rate.
Yeah, I mean, it's spot on. I'm sure on those 2 points is know what your billing model is and pay attention to that, but then go through the.
Exactly.
And so let's just turn that crank one more time then. So then what do you invest in customer success in order to help reduce churn? Because I think that's a lot of people are thinking to themselves right now. If they're a little earlier, for those of you, because I saw a bunch of you Series A, maybe have not made the investments in customer success yet. A healthy chunk of you are Series B, so perhaps you have. But how should people think about those investments in customer success to manage churn?
Yeah, I mean, there's a whole bunch of different thoughts on that. It does depend on the customer. For us, a lot has to do with the initial launch and the initial onboard of the customer, and you know, make sure that they're using the product and they understand how to use it, and really getting it ingrained and showing them the value of, like, why use Vidyard. Here's why you should use it, and show them that. And that's how you really build the software into a product that they need, rather than kind of have as a nice to have, right?
We got this phrase that I share, because I spend a lot of time with our customers. It's just go live plus adoption equals renewal.
Yeah.
And that looks like different things for different people, but you expect what you inspect. If you can inspect time to go live, and then how much user adoption there is by managing engagement with the product via the platform, that is a really good indicator in the data you want to get over, and one of the biggest early indicators in order to help manage the churn. Bruce, just going back. Go ahead.
Sorry, Dave, just to add to that, I mean, you know, often customer success can be a revenue center too. You know, they end up being closest to the customer, right? And, you know, what does the customer need? What's next up on the product development cycle? And, you know, they're often in a position to have their ear closest to the ground as to what a customer is willing to pay for in excess of what they're currently paying for. So, you know, it really is critical to get the left hand and the right hand working together there.
And I want to say one more thing on churn, because we have the luxury of been through this a lot, and some of the audience might not. There's some different ways to manage or track churn, or define churn rather, Bruce. What, if you could, like, what's your favorites about what you think really shows the health of the business?
You mean in terms of the churn percentage, or,
Yeah,
I mean,
a
obviously,
number to track against.
yeah, I mean, you know, in really fast growing companies, and that tends to be characterized by ones that are a little earlier in the life cycle because they're adding on big percentages in terms of the growth. Obviously, the quicker you're growing, the higher number you can afford to churn out the bottom, you know. But as you mature and the growth becomes a little more challenging, and you've picked off the low-hanging fruit, and your customer acquisition cost may be going up as a result of, you know, the fruit isn't as low-hanging, or you've attracted more competitors to the space and the demand gen has gotten more expensive, you know, you really need that percentage of people that are going out the bottom to come down dramatically. And, you know, obviously, the closer the percentage of churn gets to the growth rate, the more of a problem you're going to have, because, you know, at some point those two lines are going to cross over. So we spend a fair amount of time looking at the gap between those two percentages. And, you know, I get a little nervous depending on the category, again, because it can be specific when, you know, that gap gets to be anything less than sort of 50% in a growth environment, you know.
No, it's spot on. Okay, thank you. We're going to move on to the next one of these, kind of build on top of it. And because cash continues to be royalty on what we're trying to deal with right now, and it's pretty clear on how do you define free cash flow, but that's the business that you want to take in. And Matt, again, back to on the Vidyard story, and maybe representative of the Kitchener-Waterloo tech community, what are people doing right now in order to be smart about increasing cash flow?
Yeah, I think, you know, it depends again on the business, and probably most importantly is, you know, just knowing customers and you know, focusing on customers and customer retention, and you know, but also at the same time understanding that everyone's in the same situation right now with the pandemic. So you really need to, you may need to make some, I mean, some modifications to collection policies or whatever it might be. But I think, you know, cash right now, everyone is really focused on, everyone's really focused on it, right? Do you have enough cash in the bank? How do you make sure your customers are happy and retain on and continue to pay you? And just focusing on that entire scenario of cash coming in and cash going out.
Yeah, it's going to lead us into our second point on getting into the second on how you use people, process, and technology to automate steps, and that's kind of our natural segue into all this. I just want to start off with this slide. This slide kind of describes starting at the bottom and working your way up, what it is, and this is aimed at B2B firms. So if you're B2C, I apologize, it's not as spot on for you. But you start early days and trying to get product market fit is defined in not a lot of customers, but as static customers. It'll give you a tremendous amount of product feedback and become your advocates once you're really managing cash. Then that grows into improving your revenue model through an efficient sales machine that delivers the growth rates that you want to see, where you start tracking on there in the far right unit economics. That then leads into improving the net expansion revenue model, which is keeping the growth rate up and proving you can get people buying from you a second and third time, where in this case, now you're trying to automate the ability to be aware of that subscription lifetime and what happens, all the upsells and downsells, and see what the value is per customer. And for those of you aspiring to more, and I hope you're aspiring to more, then you're trying to make all this repeatable with a lot more analysis. And then at the top end of the market, have a very predictable cash efficient machine that allows you to move into adjacent markets. So against this backdrop, Bruce, as you're guiding folks through, what do you think, and as you're looking for people, and the majority of our attendees here are Series A and Series B, what do you guide your companies to focus upon as they're trying to get to that next level of growth?
Sure. Well, I'm fond of saying that Matt's going to not like this as a CFO, but I mean I'm sort of fond of saying profit's overrated in a growth environment, okay? Because we can turn off the sales and marketing machine anytime we want in a healthy company and drive as much of that expense, turn that into a bottom line when we choose to. But in a growth environment, when I look at a chart like this, once we get a product market fit as characterized by a number of customers that are happy, satisfied, to Matt's earlier point, have indicated that by saying I'm up for a renewal. As long as I can attract customers for less than what those customers are worth to me over a reasonable period of time, I'm saying let's go, right? And thankfully, in order to do that, you need investment. And that's where Round13 comes in, because that's our business, right? So that's I'll admit I have a vested bias to have this point of view, but I really do think that when you look at the health of a company with a background of a chart like this, you really do need to look at the gap between what it's costing you to get a customer and what that customer's worth. And if it's healthy enough, and you've got a strong enough CFO, right? That CFO will realize that at one point that is going to form the foundation of your gross margin. And you should take comfort in the fact that if you decide to reduce the expense because you have to drive a bottom line, or you always should keep that in mind, that at some point we all have to turn a profit as we mature. But that brings me a great deal of comfort that can be achieved, because if that gap's a healthy one, then there's no reason that shouldn't continue, but you have to pay attention to it at every stage of the cycle as you grow.
Well, I want to say one thing. It's your point of view, because it's a good point of view, because it's showing great investment in company and shareholder and customer returns, that attitude. Matt, as Bruce just laid out, we need a strong CFO on managing that. So how do you balance those two with the P&L leaders, because they want more, and you're like, show me efficiency.
Yeah, that's a great question, and that is a constant discussion and balance. And I remember.
And if anybody from Vidyard is watching this video right now, you can get some of the insights on what Matt's thinking, so you can get a little more P&L out of him.
Yeah, I remember we spend a lot of time. We still look at this. We kind of look at an efficiency score, and how much is it costing us for new revenue, and we track that all the way along. And you set an acceptable range or a target, and you try and manage within that. And so yeah, that's if it's costing you $1 to get $1, is that the efficiency that you want, or is it less or more than that, right? And depending on your stage in business, you can use that as kind of your line in the sand to manage against. And then the other thing is just levers. Knowing the levers that you can pull and put on the gas and pull off the gas to grow is another thing too, because it's there are certainly times when you need to step on the gas, but there may be times when you need to pull back, and you need to have the ability to do that. So knowing those levers is important.
Can we blend those 2 points that you made, though? Bruce, you're talking about pouring gas on the fire, and then Matt, knowing the benchmarks where you come in, because we got a lot. I mean, it's somewhat of a who's who of the up and coming CFOs in Canada right now on the line. How do you build those benchmarks for yourself, as to know where the yellow lines of the road are to guide that?
Yeah, so I think it, for us, we've always used, it kind of depends on your product market fit, as Bruce said. It depends on, have you raised, do you have the funding to actually step on the gas? And, what's the time? Is the time now? And if it is, and there's an opportunity or a market opportunity, then that's how you know to step on it, I would say.
Bruce, how do you build the Kiriatsu in the portfolio to help each other out on that?
Well, I mean, it comes back to, I think what this hour is all about. And that is, I've watched over the years the access to data become better and better and better and better and more timely. And, the thing about customer acquisition and customer behavior is it can now be measured in pretty close to real time. So I think the well functioning organizations have got the CFOs, on with their hand on this pulse, every week, and it's like we adjust on the fly. There's no such thing as, here's our 2-quarter plan, irrespective of what we learn over the next quarter, which we would have had to do a lot more of in the old days. And I think, that there's no excuse not to have the access to the data for the decision making now, and that is, obviously something you need to have in place.
This kind of the ability to get that visibility is then what allows you to be the Jedi Knight to think about what the business is going to be and guide people in. Then, because you're coming from a position of power, not power is the wrong word, but rather competence on helping make these decisions. So
yeah, and in the old days, you threw some brand money out there, and you were sort of like a leprechaun at the end of the pot of gold, right? Hoping that it sort of landed. And it's, there's just no more excuse for that, these days, as Matt knows, right? It's just not going to happen. Like, you don't need to, right? You've got what you need.
That is a great metaphor. I really appreciate that metaphor.
Hollywood.
We've found a pattern on to say all this, because this section, part 2 of this section, is a little bit of what you can do. And from all of our interviews and all of our surveys, so again, this isn't ours, this is your peers found this over time. A lot of you are operational minded and want to put, defined projects in place. Here's a path to follow that your peers are following. Starting here on the bottom and working your way up on 1, 2, 3, 4, 5. Is if you can, and this again depends on your model, but whatever is building the quote, if you can integrate that into what is building the invoice, and you can line up the item masters between the two of them, then all of a sudden billing and revenue rules automatically come over. So you get those shot out, which faster invoicing, so faster collection, so more improved DSO. And then by doing that allows you to iterate quite a bit more on what the billing is. We're back to who your customer is and your persona on the pain that you're taking away and how they define value, what you're able to automate and put in different billing. Both of those allow you to then have revenue locked in and what's both deferred and recognized, which is the core component of where evaluation comes from as you're going to do more fundraising. When you got those 3 things in place, the data is there, both in GAAP and SaaS metrics, to provide to the executive team and whoever else you want to open it up to have them understand how each of them is touching the customer across that customer life cycle. And then once you put all those 4 pieces of infrastructure in place and you get yourself a data set, then you can start doing some FP&A and then predictive analysis of what is likely to happen with billing and revenue and cash. And then that's where true business agility comes in to pivot to get in front of others. Matt, I mean, the Vidyard store. Oh, go ahead, Bruce.
Sorry, I think it's a very good point. It's a very good slide, and I just want to add, when we get excited as investors, is when a company shows up, and back to my earlier point about it really not being a technology barrier to entry, it really is a sales and marketing barrier to entry. And if they can show up for a Series A or a Series B and say, listen, we've tested, here's the 27 channels of customer acquisition we've tested. Here are the 6 that make all kinds of sense. And here are the metrics to back up what I'm saying. And if they can convince us that 80% of a $10 million check can go into repeating that behavior, that's a dream to us, right? Because that takes a lot of the risk out of our investment. And the data doesn't lie. So really the risk is there enough room left in those 7 channels to keep the unit economics the same? Because presumably you've got enough data now on the customer side to say, listen, this is how our customers behave after 5 years of of getting to know them. We've got a pretty good profile on them. So if that marketing number, which goes into the CAC, can hold, and you can put a lot, a good chunk of money to work, then that's like a real win-win. If we can agree on valuation and all the other things that go into that discussion to you CFOs, that is a really good place to have a conversation from. It's a position of strength for you.
Yeah, and I think, gosh, if all of you listening right now, there's the tip, right? Is being intellectually honest with yourself on what's really happening with the data allows you to constantly experiment and then prove it out. And the investor, if you can prove that out, the investment is there, right? Bruce and others want to come in, put money in there. Matt, do you mind if I ask you though on the cultural component? Because this is one of the most powerful things about the Vidyard story is how great a culture of trust you guys have built, men and women as a team have built across the executive team in order to apply this. So how did you guys build the trust to then be able to look at the data, not be defensive about it, but instead say, this is what it's telling us, here's what we should do?
Yeah, that's a great question. So just for some, I guess for some context, we have, our culture top to bottom. We, at the very highest level, we have an executive leadership team that we call an ELT, and we have basically representation from each functional lead, CX, customer, product, sales, marketing, finance, and everyone. And a lot of it just goes back to data, right? And being able to pull together and surmise all of the data into key metrics, key dashboards, and then bringing that to the executive leadership team and having that team work as basically a cohesive unit where there's no egos, there's no reason we can't ask questions, there's no reason not to challenge somebody, there's no reason to be upset when someone challenges you. That's how you get the cohesive team working, and you use the data to validate your assumptions or your decisions or your intuition, whatever it might be. That's the place where we like to get to.
Yeah, it's the leader's role, get everybody pulling the rope the same way. So if something goes awry, it's not like, oh, I messed up. It's like that experiment didn't work. Let's all work together as to what we're going to do next. I've learned this, I advise a number of firms too, and the ones that have that in place are just, it's so much more fun to work too, by the way, getting in there. So let's just wrap up on this third point, how the finance function is changing, because it is changing. This isn't meant to be completely comprehensive, but with everything that's going on around us, starting at the bottom and working our way up, there's this new role that's come up of revenue operations fitting in between some of the major departments and changing from just being a data entry clerk into doing a lot of revenue analysis. And then of course the classic role of sales ops, trying to put some consistent sales policies in place, often in the opportunities coming in, and the controller wanting to have a clean process on that. It's going to lead to a good close. Then that data goes to FP&A, which then goes to the CFO to guide a lot of the decisions that we've been making. Matt, again, not just the Vidyard experience, but as you talk to a large number of peers, what are people thinking how all this is going to change, and what's the new leadership role finance is going to need to play going forward?
That's a great question. I spent a bunch of time with various CFOs and other leaders talking about this. I really do think the finance role is changing, and the CFO or the finance leader is changing, and it already has started changing. And we've really come out of historically what would be reporting, budgets, cost control into more of this finance team, and the CFO or whoever the finance leader is needs to be more strategic. They need to have kind of a bigger role, an advisory role, be part of the leadership team, because this finance group, including the leader, has more insight and more data and more knowledge than most others in the business. And so need to be part of that strategic team and decision-making team, and not be afraid to voice your thoughts and opinions. And most of it will be backed by data. I mean, that's kind of how our operations go. So as we see that changing out of the kind of cost control reporting center into what I would probably surmise into a, not how do we adhere to budget, but how do we help the business allocate the finite resources we have and prioritize them into the things that are going to help us grow. Like, help us strategically prioritize and allocate things, not make sure people follow budget.
That's a whole other mindset, isn't it? I mean, cost police into business enabler. Bruce, I feel like you got something you want to share on top of that.
Oh, I mean, that's just an echo. I've seen it evolve over the years from, the finance department being a place, really a service team, right? That provided the reporting and, told us where we were at, and still very important to show up at the board meeting and, give answer the tough questions. But there has been a tremendous evolution into thought leadership now. And it has been a direct result of some of the stuff we've been talking about today, because they get first look, and to the extent that the finance team understands the business, which they increasingly do, then the contribution can come from anywhere, right? And particularly the people that control the data, the power has shifted over to that team. There is no question.
It's true, and it's every department, by the way, has data. But I find time and time again, though, it's finance is the one team that's thinking about the entire customer life cycle. And so marketing is looking at what MQL is, what CAC is, and sales is looking at what the pipeline is, what conversion rate is, and customer success is looking at upsell. But someone needs to transcend a little bit above all that to say, and so here's what the journey is with us. And we get into a little bit of what customer lifetime value to CAC and figuring out what the magic number is a little bit. So because I want to go into a little bit deeper on this. This is some data from another firm we work with, Round13 Capital, on how to think about doing your scenario planning. And it's every bit, because we're back to people, process, and technology. This is about people and process on where are your uncertainties. I'm going to just read them off. You can read them, bucket them, craft responses, have your triggers that you know what you're going to do in order to do all this. But there's a cultural component on this. And Matt, I keep going back to this because I think this is such an important linchpin of Vidyard success is you guys have been able to be very agile as the market's moved. How have you gone about creating that cultural component to being able to see scenarios and respond to scenarios?
Yeah, good question. And I think I kind of alluded to this last time, but the culture of having kind of a no egos policy has been key, because we need to have all the things coming in. We need to have all the data coming in. We need to have data from all sources coming in and surmised into our dashboard. And we need to have scenario planning constantly happening. And we need to bring that forward, and just having a culture where we can bring ideas and bring data and bring information and just not have any worries or egos about constructive conversations all the way across the teams is just so important. And that's how, we're not afraid to shift or change things. And as you're constantly doing scenarios and you have real-time, active, reliable information and data, you can make these changes on the fly. So you don't have to wait a quarter to make a change. You can do it straight away.
It's Meg Whitman. I don't know if this was attributed to saying this quote, is the best managers in the world hire right half the time. So it's the old hire slowly, fire quickly. But it's amazing to me, and maybe it's always been this way, and I'm just more aware of it now, but every bit as much as you're trying to hire, and you often hire for competence, there's also like hiring for self-actualization, to be comfortable enough with yourself to be able to be agile, and something going wrong isn't a personal attack, but rather like a choice that wasn't the best choice. And then how do you be strong enough to try to make a better choice and hiring for that? I don't know, Bruce, as you're building teams and investing in people, what do you see happening there?
Listen, I'm in my late 50s. I'm finally officially done with working with people, investing in people, partnering with people. that can't get up in the morning, look in the mirror and say, I made a mistake. I didn't think about it that way. You know, we are so far past the time when one person can have all the answers. There's just too much information. You know, we've created more data today, or this week anyway, than we have in the history of mankind, right? If you know, like, there's just the days of somebody having it all, you know, contained in every answer to every question are long past. And you know, I've just seen too many excellent ideas be ruined by ego and lack of cohesiveness and a lack of introspection. And quite frankly, I've seen a fair number of mediocre ideas that have knocked the ball out of the park when you've got people that understand how to work together. And it really, you know, we are at a golden age in so many ways, in the fact that the data is so abundant. And if you're willing to put in the work, the answers are very clear. But if you are stuck on pride of authorship, or, you know, not wanting to lose face, or, you know, an unwillingness to concede, I mean, that is just, you know, the kiss of death. And I would just add one more point. You know, things are moving so quickly as a result of the data explosion that we don't have time as businesses to sort through whether somebody's presenting a point of view because of another agenda other than what the data is telling you. Just a complete waste of time, and we don't have that time. You know, if you're spending time on that, I can guarantee you your competitor who did get the culture piece right is marching ahead, and they're going to kick your ass, right? So whatever time you need to put in to change Meg Whitman's 50% to 63.5, put it in, because you're not going to change people fundamentally at this stage of the game, that you're, you know, on the average age that you're hiring. You are who you are, right? So get it right coming in. It's worth the extra time to try and achieve that, in my view.
Matt, can you build on that? That was, geez, Bruce, that's just right there, right? That's for all of you listening. We're back on this third tip that we're trying to make, how the finance function is changing. We bring the data, but it's also you as leaders can bring that back to, here's who I want to hire. The CEO, here's what we should be thinking about. Man, I don't know. I don't want to put you on. You talked about culture twice. You can tell I'm a fanboy of Vidyard and what you guys have done and all that. Let's kind of wrap up on this. Just a little bit. I'm sorry for the audience. It's somewhat self-serving for us, but it's also self-serving for Matt on. And this is very aimed at, you know, the pragmatic, that when you start with these issues that are happening and what you're dealing with before, that going through people, process, and technology, because Intactus plays its role amongst a great team and culture, you're able to, you know, get this information. So I love the first one is, by having data, you guys were able to invest in hiring ahead of plan for engineering teams, and then had the data to reduce your own CAC with these honest assessments. I don't know if there's anything else, more color that you want to put on this set of outcomes you guys have had.
Yeah, no, I mean, data, to be honest, data and dashboards and true, timely information that is reliable is key to all this stuff, right? I mean, that's what it's all about, and that's how you make decisions, and that's how you drive the business, and that's how you avoid a lot of the you know, personal conflicts that might come up, because data is data, and it's real, and it's information. If you've got it and it's accurate and it's timely, that's how you make decisions. That's how you reduce things like CAC, and that's how you improve efficiency and grow.
My favorite part of this slide, though, is, for all of those of you in the audience who are listening who are leaders, is Christine works for Matt, and just look at that kind of like self-validation and joy that comes from work on being able to be utilized for the strengths that you have, and putting time from doing data and what we talked about, like the data historian that the finance role was traditionally, all of a sudden to being a strategic contributor to our growth. And who doesn't want more of that? Who doesn't want to wake up every morning thinking, I get to be some of that today? And that's a really neat, and it's my favorite part of this whole thing. So we just briefly on us, if you're not already aware. We help companies just like you get your arms around the subscription financial management through driving those 5 patterns. I'm going to keep it simple there because it's not so much about that, but I wanted to put context around who we are. We've got time for some questions. We got a bunch of them that have been coming in, and for those of you in the audience, we'll go for like 5 or 10 minutes on answering some of the questions that we've got. Bruce, I'm just saying this was for both of you guys. So one of the audience said, for CAC, how do you weave in customer success and the expansion costs of upsell into CAC when you're trying to model the value of a new customer?
So, Matt, you've got the CFO answer to that, but the operator's lens is, the revenue. The use of customer acquisition cost is only helpful in the context of what a customer is worth. And a component of what a customer is worth is not only what they signed for originally, but what they have shown a tendency to adopt in terms of services or extra products that will add to that annual recurring revenue or monthly recurring revenue. So it doesn't affect the CAC directly, but it affects the all-important payback on CAC metric, which is the revenue component. So you need to capture what a customer is truly worth to understand what you can afford to pay to get the customer, and to ensure that, as we talked about earlier, that the gap between those two numbers stays healthy.
Matt?
Yeah, I completely agree. And we were talking about this at some point, but the lifetime value of a customer, taking that stuff into account, is critical. And in relating your customer acquisition cost to your lifetime value, that's a very important metric. You should have, depending on your industry and customer, you should have a metric that you're looking for, whether it be 3 to 1, 4 to 1. The lifetime value of a customer should be worth that 3x what you're paying to get the customer, that type of thing. So I completely agree that you need to look further at retention and lifetime value than just the CAC.
So we got another question that just came in, which is, how do you manage who is the customer from a CAC and COGS perspective when you have a marketplace platform with one side subsidizing the other side of the platform?
I think you have to look at it cumulatively, because in a marketplace, and it makes it tricky, the tricky business models and sometimes a lot riskier business models, because you need both sides of the equation to end up with a deal, if you will. So you have to look at it cumulatively. One doesn't work without the other. So what's my combined cost of acquisition on both sides? And then as you look at the revenue, same thing. It's a transaction usually, or a date in the case of the online dating matching business, that is that yields revenue, but cumulatively from both people. And one thing we didn't mention, the question mentioning marketplaces just brought it to mind. The thing that you can't ignore, and you need to find a way to try and get at too, is you'll get a customer. Somebody wanted to use Lavalite, for example. I think when I left the business, on average, they would bring an additional 1.4 people with them to the platform because they enjoyed the experience. So those are cost-free additional members, which we call viral, right? That have to be, if you can, worked into the customer acquisition cost, because that drives it down. And you're obviously then willing to spend more if you know that 1.4 additional people are coming with that customer. But the quick answer to the question is you have to look at it cumulatively in a marketplace.
Okay, got it. Thank you. Matt, if you want to add anything to that, or we can just move on to the next question. It was pretty comprehensive, Bruce.
We're good.
Yeah, thank you. Matt, a question for you on your end is, it's from a little earlier stage firm, but what's your board asking from you in the board meetings that's different than before right now? I think, and if I'm kind of putting some words in the question asker's thing, is they want to be better prepared for the next meeting.
That's an interesting one. New questions, new things I may ask. You know, I think it's just, and Bruce alluded to this earlier, as the business grows and as we have more customers on for longer periods of time, I mean, we have customers that have been with us for 6, 7 years. There's an expectation that we know the customer profile better than we ever have. And we continue to learn, buying patterns, paying patterns, upsell patterns, retention rates. And so, you know, the predictability of the business should continually improve as we learn more about how customers are using the product and how they're retaining or what they're interested in. So I think just, you know, in the early days of not, you know, you'd calculate, for example, you'd calculate a lifetime value and it would come out at, you know, a really high number because your retention rate is really strong, your churn's really low. And you think about that in years and you say, wow, our lifetime value is probably 10 years, but you've only been in business for 2. So does that actually make sense, right? But as your business grows, you actually get a lot more data and some real historical information that you can use and be much more accurate with your predictions and your modeling and your scenario planning.
Got it. Bruce, from you on the investor side, what is it that you're asking different so our audience can be a little more educated how to prepare for board meetings?
Yeah, no, I think on the early stage companies, you're looking for you're laying down patterns, right, that you hope to be able to build upon as you go for subsequent rounds of financing. So you're really looking for establishing the foundations of what you're going to be pouring capital on top of. And I think as a company matures, you continually are asking yourself, okay, where is the efficient growth going to come from? Because, you know, like it or not, when you do take the decision that you're going to take in outside capital to help you grow the business, you're going to be accountable to somebody other than yourself. The conversation as you go along does shift to growth, and where is the next wave coming from? What are the competitors up to? So there's a looking for some value add. That doesn't show up at every board meeting, what the competitors are doing, so if you got some spare time and you're hunting around, like, that is very valuable stuff, and what are they doing in a product that might not be on your roadmap yet, that kind of thing. But we really are looking at how we can effectively spend more money to create value in somewhat a fashion that resembles what we've done before, that we were so excited about when we first came in, So I think that's the nature of how things evolve, early stage to mid stage to sort of more mature.
I hope that's wonderful insights from both of you. I think first off, all of you who've been joining us for the webinar, we really thank you for spending the time with us. We hope we're able to help you and guiding the business, and that's why we want all three of us want to pay it forward. Please join me in thanking Bruce and Matt for spending the time and sharing some wonderful, insightful perspective with everybody. Please thank our families and dogs for not making too much noise in the background as we did this session. If there's not any final comments from you guys?
I think we covered a lot of ground, and I'm excited to whenever you get a chance to sort of look at the intersection between operations and financial measurement. I think it's been a great use of an hour for me. So thanks for having me on as a guest.
My pleasure, Matt.
Agreed. Yeah, no, I appreciate the time. Happy to help, and look forward to a bunch of growing Canadian businesses here.
I know. It's just been a cacophony of data we've just covered today. So it's been amazing. So everybody have a great day.